Topic 4, Performance Measurement. Exercise 1. Let's read the question. Toro, a national manufacturer of lawn mowing and snow blowing equipment, segments its business according to customer type, professional and residential. Assume the following divisional information was available for the past year. So this is information for residential and professional. Assume that the management has 25% target rate of return for each division. Okay, so we have to calculate the ROI, okay, the sales margin, the capital turnover, and then use the ROI formula to confirm the result from requirement 1 and calculate each division RI. So the first requirement, return on investment, operating income over total asset, we get 34% for residential and 42% for professional. So it means that each division's ROI is very high. However, the professional division has higher percentage than the residential. Requirement 2, sales margin, operating income over sales, we get 8% for residential, professional 14%. So professionals has a higher sales margin than residential. Okay, capital turnover, sales over total asset, residential we get 4.25 and professional we get 3. What does it mean? It means that professional division is generating 3 ringgit of sales for every dollar of asset invested in the division, while the residential division is generating $4.25 of sales for every dollar of asset invested. So residential is higher than professional in this case. Requirement 4, the ROI, sales margin times capital turnover. Residential we get 34% and professional 42%. So professional is much higher than residential. So even though the residential division efficiency as measured by capital turnover is higher than that of the professional divisions, the professional division's profitability as measured by sales margin is so much higher that it causes the professional division's ROI to be much higher than residential divisions. Requirement 5, residential ROI, residual income, 18,000 for professional, 62,050. So professional ROI is more than residential. Exercise 2. Okay, reads the question. Results from Pioneer Corporation's most recent year of operation is presented in the following table. So operating income, total asset, current liabilities, sales, target rate of return. The requirement, calculate the sales margin, capital turnover, and ROI. Calculate the residual income. Okay, so sales margin 24%, capital turnover 2.75 times, the ROI 66%. Okay. Requirement 2, the RI residual income, we get $7,280. Exercise 3. Okay. Spring Company has the following data for 2013. So we get this. We have this all information. Calculate the EVA. So the EVA for division A, okay, after you put all those figures, you get $32,000. For B, you get $6,000. Exercise 4. Farid Company manufactures and sells wood burning stove through 3 divisions, local, commercial, and international. Each division is evaluated as a profit center. Data for each division for 2012 are as follows. So sales for local, commercial and international, cost of goods sold, selling and admin expenses. The income tax rate for private company is 40%. Private company has two sources of financing, bond paying 8% interest, which account for 20% of total investment, and common stock at a cost of equity of 18%, which accounts for the remaining 80% of total investment. Farid's total capital employed is 3 million. Okay, this information. 2.1 million for local division, 0.5 million for commercials, and the remainder for the international division. So calculate the after-tax operating income for each division, weighted average cost of capital, and EVA for each division. So for A, private company income statement for the year 2012, sales for local, commercial and international, cost of goods sold, gross profit, selling and admin expenses, and we get the operating income minus income tax 40%, and we get after tax operating income. Second one, okay, the weighted average cost of capital, the common stock, the percentage is 0.8, after tax cost 0.18, and the weighted cost is 0.1440. The bonds 0.2%, 0.2 or 20%, okay, times with the after tax cost 0.048. So this is the calculation how you get 0.048 and get the weighted cost, okay, of 0.1536. So for number 3, the EVA after tax operating income less with the cost of capital. So we get a local 134,560, and for commercial 239,200, and for international 88,560. Exercise 5. Kitchen Aids makes a variety of products, including stand mixture. Kitchen Aids stand mixture divisions can use a components K32, manufactured by Company Aids Electrical Divisions. The market price for K32 is $18 per unit. The variable cost per unit for K32 in the electrical division is $13, while the absorption cost per unit, is $16. The divisions at KitchenAid use a negotiated price strategy to set transfer prices between divisions. What is the lowest acceptable transfer price to the electrical division? What is the highest acceptable transfer price that the stand mixer divisions would pay? Explain your answer. So the lowest acceptable transfer price to the electrical division is $13, and the highest is the market price of $18. So the lower you use the variable cost, and the highest you use the market price. The electrical division would not transfer the component for less than its variable cost, that is $13, or it would be losing money on each transfer. The stand mixer division would not pay more than the price that it can buy the components on the market for $18. Exercise 6. Okay, Green Motors manufactures specialty tractors. It has two divisions, a tractor division and a tire division. The tractor division can use the tire produced by the tires divisions. The market price per tire is $55. The tire division has the following cost per tire: direct materials and conversion cost. Fixed manufacturing overhead cost for the year is expected to total $100,000. The tire division expects to manufacture 50,000 tires this year. The fixed manufacturing overhead per tire is $2. Okay. The requirement assumes that the tire division has excess capacity, meaning that it can produce tires for the tractor division without giving up any of its current tire sales to outsiders. If Green Motors has a negotiated transfer price policy, what is the lowest acceptable transfer price? What is the highest acceptable transfer price? If Green Motor has a cost plus transfer price policy of full absorption cost plus 20%, what would the transfer price be? If the tire division is currently producing at capacity, meaning that it is selling every single tire it has the capacity to produce, what would likely be the most fair transfer price strategy to use? What would be the transfer price in this case? So the answer, the lowest price is the variable cost and the high price is the market price. Requirement 2, direct material 25, conversion cost 3, fixed manufacturing overhead 2, and profit 20% times the $30, you get 6, and the transfer price would be $36. For requirement 3, it is the market price, $55. Okay, for final exam, the income statement for Division A is as follows. Okay, Division A, income statement for the year ended 31st December 2018. So this is the information. Division A is an investment center that uses return on investment for its performance measure. Management bonuses are also based on ROI. All investments are expected to earn a minimum return of 15%. At the end of 2018, the division's total productive asset is 63,000 RM, which is a 5% increase over the beginning balance. The total cost of capital is 10%. Division A has an investment opportunity of 60,000 RM that will generate additional sales of 16,000. This investment will occur additional variable cost of 6% on sales and 600 on fixed costs. By accepting this investment, Division A will increase current liability by 4,000. So the requirement, okay, calculate the ROI for Division A for the following without new investment, with the new investment. So ROI without new investments, okay, we get okay, the average balance, and then ROI without investment is the income before tax over average productive assets. Okay, that we calculate here and get 20%. ROI with investments, okay, we get 22%. Okay, so residual income before tax minus minimum rate of return times average operating asset. So you get the residual income of 5,440, except because RI is positive. So for EVA, okay, income after tax minus cost of capital times investments, and we get the residual income of 4,508, except because EVA is positive. The advantages of using residual income is that its use encourages managers to accept any policy that earns a return that is above the minimum rate. So anything that you can explain, that will be accepted.